Imagine bypassing the slow, grinding process of growing a small retail trading account. In 2026, proprietary trading firms offer a clear path to managing 6 figures of institutional capital, completely removing your personal funds from risk. But paying a $500 evaluation fee alters your psychology immediately. You transition out of a standard profit-seeking mindset and enter a highly restrictive, high-pressure risk management environment. This chart shows the harsh statistical reality of the industry. The vast majority of retail traders enter the top of the funnel, but an overwhelming number fail their Phase 1 evaluations, leaving only a tiny fraction who actually secure funding. These failures rarely happen because the trader lacks market skill. They happen because the trader operates a perfectly valid strategy that actively conflicts with the firm's strict underlying rules. Securing a funded account no longer depends entirely on your ability to pick winning trades. It requires auditing multiple prop firms to find the exact rule set that accommodates your specific operational edge. The early, gamified era of prop firm challenges is over. The industry is currently dismantling the models designed for quick, impulsive payouts and replacing them with rigid, institutional-grade standards. Regulatory bodies, specifically the U.S. Commodity Futures Trading Commission, a government agency that regulates derivative markets, are applying pressure. Surviving firms are adopting highly transparent, legally sound corporate structures to remain compliant. The evaluation process itself has completely changed. Firms now deploy artificial intelligence to continuously scan your underlying behavioral consistency, looking far past whether you simply hit an 8% profit target. The algorithms actively track your exact risk-to-reward ratios, the strictness of your position sizing, and how objectively you manage your emotions during inevitable losing streaks. Over-leveraging a single position during a major macroeconomic news release to hit your target in one day will no longer secure you a funded account. It will immediately flag your profile for manual review and likely lead to rejection. The barrier to entry has truly evolved. You have to mathematically prove your trading behavior makes you a sustainable, long-term asset to the firm's capital pool. The maximum drawdown rule dictates exactly how much capital you are allowed to lose. Misunderstanding how this specific limit is calculated is the primary reason accounts are terminated. You have to track 2 limits simultaneously: the overall drawdown, which is a fixed percentage cut from your starting capital, and the daily drawdown, which is far more volatile and calculation dependent. On the right, an equity-based drawdown. The red loss limit aggressively trails 5. On the left, a balance-based drawdown. The red limit stays perfectly horizontal, anchored to your midnight balance. Swing traders require this static, balance-based calculation. They set wide stop losses and routinely absorb deep intraday pullbacks as part of their strategy, which an equity-based rule would instantly flag as a failure. Accepting a 75% profit split from a firm offering balance-based drawdowns yields a significantly higher statistical survival rate than chasing a 90% payout under a highly restrictive equity-based model. Marketing campaigns from newer firms frequently advertise a 100% profit split. Those full payouts are heavily subsidized by hidden operational costs.
Firms extract that revenue through steep monthly data fees, simulated slippage environments, or exorbitant reset penalties applied the moment you breach a rule. You also face strategic restrictions. Many retail strategies rely entirely on high volatility events, like non-farm payrolls or consumer price index data releases. Numerous prop firms prohibit holding positions over the weekend or trading during major news events. If you execute a trade during these windows, the firm will terminate your account, even if the position was highly profitable. Before checking profit splits, you must forensically audit a firm's terms and conditions to verify they haven't outlawed your specific trading mechanics. Managing a $100,000 funded account triggers severe neurological stress. The psychological weight changes entirely, despite keeping your risk percentage identical to a personal account.
To survive the pressure of the daily drawdown limit, you must detach from the monetary value. Professionals calculate risk exclusively in R multipliers. This metric defines risk per trade as a single static unit, removing the emotional response tied to losing dollars. You also have to follow a strict walk-away protocol. When a professional hits their maximum daily loss, they shut down their terminal. Amateurs attempt to win the capital back, trigger a cycle of revenge trading, and lose the entire account. The strict limits imposed by prop firms are actually a necessary psychological safety net. They enforce the exact mechanical discipline required to survive the markets over a multi-year career. Conduct a ruthless self-assessment before paying a single evaluation fee. Write down your exact average hold time, your preferred assets, and your baseline risk-to-reward ratio. This decision tree matrix shows how to route your profile to the correct firm architecture. Notice how a strategy with hold times under 1 hour and a high win rate maps directly to an instant funding model with tight drawdown rules. Scalpers thrive in those instant funding models because their extremely tight stop losses naturally protect them from rigid daily limits. But look at the alternate path. A trader holding positions for over a day, utilizing a 1-to-5 risk-to-reward ratio. That swing trader must route to a balance-based firm. They actively trade away the highest absolute profit split to secure the breathing room necessary for their long-term hold times. Direct. There is no objective, universally perfect prop firm. There is only the exact right operational fit for your mathematical edge. Even with perfect psychological discipline and exact firm alignment, your evaluation account relies entirely on the quality of your broker's execution feed. Severe execution slippage or widened spreads during a highly volatile trading session can artificially inflate a small loss, pushing you past your 5% limit and instantly failing your challenge. You must utilize an institutional-grade ecosystem, like the FXNX NX1 account, to guarantee your strategy is executed with 0.0 pip spreads and minimal latency. That execution infrastructure must be built on regulatory stability and transparent legal frameworks. Platforms operating under stringent international licenses, like those enforced by the Mawali International Services Authority, ensure your capital environment is secure. You can also leverage proprietary predictive tools, like NXAI, to continuously scan your own data and identify destructive behavioral anomalies before they result in a rule breach. Securing and keeping a funded account in 2026 requires 3 perfectly aligned elements: mastering your internal psychology, matching your edge to firm rules, and flawless institutional execution.